This is Pre-Market Prep. I'm Brianna Valesky in for Joel Elconin. We're joined by Tucker Donahue. He is an investment analyst with GFG Capital. Tucker, thank you so much for joining us on a late notice this morning. How are you doing today?
I'm doing great. Thanks for having me on.
Before we jump into the markets, were you also a pitcher for Major League Baseball?
So I guess you Googled me. Yeah, before I pursued, I guess you could say, my financial career, I was fortunate enough to pursue a career pitching baseballs. So I played for a few years with the Toronto Blue Jays. Was actually lucky enough to be twice drafted out of college. But with an analytical mind, I figured it was probably smart to get my degree. So I turned down the Texas Rangers first, and then pursued my degree and finished my degree, and then I went and played baseball for the Blue Jays for a little bit.
Wow, that's awesome. What made you decide to switch from baseball to finance?
Um, well, baseball is definitely a business,
Mm-hmm.
so there's no getting around that. And I kind of tweaked my knee, and when you tweak a knee or something, and you're the age that I am, or I was, you start to be really turned into a commodity a little bit more. So you're a little bit more expendable. So you get hurt in your liability, and I figured I can try and rehab, or I can pursue a promising career in finance. And
Yeah,
I got a call
absolutely.
from I got a call from a good friend of mine, and said he needed a guy, and I answered the call.
Yeah, absolutely. Now you get to live in the exciting world of financial markets. So let's jump right in then and get your take on the broader market right now. What are you seeing?
Well, from technically speaking, when you kind of look at the chart, we've had a nice run up over the past 8 or 9 days. Obviously, there's no hiding that. We've kind of been range bound a little bit since the sell off late in August. And we set a little bit higher below a couple weeks ago, and now we're touching some higher closing highs, coming down obviously a little bit back below the 2000 level. We keep an eye on 1970. That's really indicative, we think, of
Mm.
where how bad the sentiment might be. Sentiment's kind of bad right now, overall speaking. So one little catalyst, it could send us lower, but that's kind of why we're turning towards earnings season as the biggest driver moving forward. It's really kind of, I think, going to swing this one way or another for the month of October.
What are you looking at like in the Dow and some small cap indices?
Well, right now it's tough to make a promising call on things when it's
Sure.
below the 200-day moving average. So we would really like to see the S&P, I'm sorry, the small cap index really work its way closer and above the 200-day. We've really experienced a pretty harsh sell-off there. So I think,
We apologize for a little more technical difficulties we're experiencing this morning, but again, we are online with Tucker Donahue. He's an investment analyst for GFG Capital. Tucker, let's just pick it up right where we were talking about in some of the indices.
yeah, just I think we were talking about small caps right
Yes.
before we got cut off. We would like to really see a little bit more bullish activity here. This would be a little bit more of a promising indicator for some positive sentiment moving into the final 3 months of the year, which have traditionally been some of the better performing months. So you see positive returns in more than 65% of the months from an October, November, December standpoint. So small caps would be a nice kind of indicator to get us feeling good again. Maybe set a higher high to break out of these series of lower highs that we're looking at. Somewhere closer to like the 1175 range would be a nice breakout. So that's kind of from a technical standpoint where we stand today. We're on the cusp of moving one way or another. I know it's not too helpful, but at the end of the day, it's kind of where we're sitting. But when we move on towards the broader earnings season, which is really the main catalyst moving forward for us, absolute figures both on the earnings side and the revenue side are expected to be relatively weak. A lot of companies, if you look at the transcripts so far, they're citing a stronger dollar, kind of being a headwind moving forward, which is no secret. I think everyone knows earnings are expected to be at a negative 5.5% for the year over year, making it the first back-to-back quarterly decline since 2009. Keeping in mind when looking at previous rate hike cycles, which is another headwind moving into the quarter,
Right.
earnings and revenues have never been negative. If we hike today or if we hiked in December, this would be the case. Part of the issue has been energy sector. Obviously, it's been a pretty big drag for over a year now. The, the sector is expected to see a drop of about 64% decline this quarter. So that's going to be a tough thing to avoid, and obviously it's going to weigh down pretty heavily. So we think possibly we could see a back-to-back quarter of negative earnings. 5.5 might be a little steep. If you look at the last 4 years, speaking, 75% of the companies tend to surprise to the upside and report higher than median consensus estimates for earnings. This being said, if you took this into consideration, you kind of would see more of a 2% decline in earnings, which doesn't sound pretty, but could be better than expected, and maybe not send us back to those October lows of 2014, which I think is a pretty big fear that you see people talking about today.
So are there any leaders that stick out to you going into earnings season, or sectors maybe that you think will perform better?
Well, I know what we would like, and I would like personally to see some consumer discretionary companies really post some strong results. Obviously, that's the biggest driver for the U.S. economy. So if the consumer is feeling good and spending money, and you can see that through some of the bigger consumer companies, like we saw initially with Nike and Paychex, these are positive signs for the consumer. So any kind of consumer discretionary, I think that will really give us maybe a good feeling of where we stand as the U.S. consumer, because at the end of the day, that's all we are. But coming up to this point, you've seen a lot of people paying up for growth in a time where the market's kind of been down. We could take Netflix as an example of yesterday.
Definitely. Let's talk about Netflix. Had an interesting earnings report, and of course, this is one of the big media ones that people are focusing on.
Yeah, it's a really big popular trend today. As a mid-20-year-old guy, I can tell you, as someone who recently relocated their life, I definitely considered not getting cable. There's definitely a ton of options out there, and it's a real threat to some of these big cable companies, and you're going to see that, I think, moving forward. It's kind of just what our generation looks for. But when you're looking at the stock, it's been the best performer year to date of the S&P 500. Yesterday we broke down, Sean and I, we broke down the stocks that were up 20% or more year to date. That group only makes up 10% of the index, but there were some underlying themes that we caught. Investors are paying up, as I mentioned, for higher revenue growers. We talked about earnings and sales growth just a minute ago, and we talk about it a lot here in-house. And S&P is seeing flat to negative on both fronts. The 20-plus returners for the year are seeing a median of 12% revenue growth, so that's 12 times the market. So this is really you're seeing people paying up, obviously, this past 12 to 18 months for companies that have been resilient in posting growth. And I think that's why you've seen Netflix just have a tremendous year up until, I guess, yesterday's aftermarket. But overall, if you look at the report yesterday for Netflix, you're still seeing a lot of growth. The company has cited that they're focusing on international growth, and they added 2.74 international subscribers. They disappointed a little bit to the street's consensus, but there's still a lot of growth in that company, and the industry speaking, it's definitely a big threat to some of the older school options that people are used to.
What about the financials? We've got plenty of the big banks' earnings reports already. Even just this morning, Goldman Sachs had a not so great report, but Citigroup had a pretty good report. So kind of a mixed bags of earnings coming out of the financials. What are you seeing in that sector?
Yeah, financials has kind of been in the limelight, I guess you can say, for some time with the whole Fed rate hikes. So obviously these have gotten a lot of attention, and maybe some of them have been priced to perfection, I guess you can say. But when you take Goldman as an example, they just reported this morning, as you said, and they missed on top and bottom. Trading revenues continue to dampen results, and this is being seen throughout the sector. I don't think this is specific to Goldman. This makes sense in our view, as the last few quarters have been really filled with a great deal of uncertainty. Are we going to raise rates? When are we going to raise rates? What's the true effect going to be? So that's really one question investors haven't let go of yet. and this has really been hurting the fixed income trading. And another question with Goldman and really the sector is the economy overall trending into a recession? Is the U.S. a little too strong for its own good, I guess? Is our supporting cast not going to carry its weight? And so this is also hurting equity trading revenues for these big banks. Either way, the winners in the financial space are the biggest cost cutters. At the end of the day, that's really going to be the theme I think you see among the companies that post good results in the next coming this coming quarter. Today we saw another bank beat earnings due to higher costs getting cut. And that's really how we're looking at the financial sector today. So it's not, we're not exactly trying to time maybe what Chair Yellen's going to say, or are we going to raise rates? I don't think anyone in our office really expected it to happen in September. So we weren't really surprised, maybe a little bit more surprised on the reaction. But yeah, going forward, I think if you can see some of the bigger institutions and the players who are in the space try to cut costs, those are going to be the ones that are going to rise to the top.
We've got a couple of chatters in our chat room over here interested about your background in baseball. Does your baseball experience at a high level help with trading, psychology, preparation?
Preparation, I think, is the most common bleed over from baseball into finance. And
Okay.
I kind of made that connection early on in college. I definitely saw the parallels, and I was fortunate that I truly loved the preparation, both financially and from a baseball perspective. I just really liked getting prepared, getting ready, and testing my will. So that's the biggest thing I think I can say I've carried over from baseball to finance now is the preparation aspect. You can never be too ready. You can never try and learn too much. And I really learned that actually when I was playing professionally instead of in college. You really continue to learn. You're surrounded by guys who have different walks of life and different experiences, and you really pick up things every day that perhaps you wouldn't really get anywhere else. And I could say that's true now working here in finance. I meet people all the time who've done things I can never imagine, and I've had a ton of interesting conversations. And on a day-to-day basis, I think I can honestly say I go home and I know something that I didn't know when I woke up that morning.
Yeah, absolutely. Another one of our audience members wants to know what you think about the future for daily fantasy.
My fiance actually mentioned the headline to me last night that the FBI is looking to probe daily fantasy in the United States. I don't know if it's illegal for me to say, but I am a daily fantasy advocate. I think it's a lot more interesting than season-long fantasy sports.
Okay.
I don't think it's going anywhere. To be honest with you, I think there's a lot of big money involved, and people are going to fight to keep it around because I think it's going to make a lot of money for a lot of companies that you see. I mean, you can't go anywhere without seeing a DraftKings or a FanDuel commercial. You can't go to a single baseball stadium in the country and not see DraftKings posted on the outfield wall
Yeah.
or something.
Yeah.
So there's a lot of money at play. So I don't think it's going anywhere, and I'm a strong advocate of it. I think it's far too much fun. I don't spend too much money on it, but I probably spend too much time on it.
Last question here for you. Will the Blue Jays win the World Series?
I think so.
All right.
I have to say that. I think they
Are you
did
obligated
used
to say
sign
that?
my paycheck. I used to have the Rogers on my paycheck. But I was kind of torn yesterday. I got a text message from a friend of mine asking me because he knew I was watching the game, obviously. And he asked me, which team do I root for? Because I was drafted by both teams yesterday, and I responded the winner.
Oh.
So no, I know a good amount of guys up in Toronto playing right
Sure.
now. So I
Okay.
have to stay true to my friends and my teammates, obviously.
Absolutely.
Plus, I think they're a very good baseball team. I think they've got a good chance. I think ultimately you'll see Toronto and Chicago in the World Series.
All right.
But
All right. We've been on the line with Tucker Donahue. He's an investment analyst at GFG Capital. Tucker, thank you so much for coming on the show today. Maybe we'll have to bring both you and Sean on again next time.
absolutely.
All right. You have a great day.
Thank you, you too.